Somebody on YouTube is going to show you their laptop, a beach in Bali, and a screenshot of $47,000 deposited while they slept. And then they're going to offer to teach you how to do the exact same thing for $997. Here's what they won't show you: the failure rate data, the labor they put in for 2 years before that first dollar even arrived. The fact that their actual business model is selling you the dream, not living it. Passive income is one of the most searched financial topics on the internet, and it's also one of the most systematically misrepresented. The gap between what's being promised and what the numbers actually show is enormous, and it's worth understanding because people are spending real money chasing something they were never given an honest picture of. So today we're going through it all. The most popular passive income strategies, the real data on what they earn, what they actually require, and a framework for thinking about which ones might genuinely make sense for your situation. We're going to call out the nonsense where the nonsense exists. And we're going to talk about what actually works for regular people who don't live in Bali and don't have a course to sell.
Welcome to your Money on Easy mode with Damien.
Quick note before we go any further, none of this is personal financial advice. I'm Damien. This is your Money on Easy mode. What I do here is break down how this stuff actually works so you can make smarter decisions for your own situation. Talk to a professional about yours. Now, let's get into it. Everyone online is making passive income. Here's why almost none of them are telling you the truth. We're talking about passive income today, specifically why the version being sold to you is almost never what the data shows. The reason the passive income dream is so compelling isn't hard to understand. We all have the same 24 hours. We trade our time for money at work. The idea that money could flow in while you sleep, while you're hiking, parenting, doing literally anything else, it taps into something deep. The concept of financial freedom, time freedom, autonomy. Those are real desires and they're worth taking seriously. But the passive income industry doesn't sell you a realistic path to those things. It sells you a fantasy version and it profits enormously from that sale. So here's the framework I want you to carry through this entire episode: the passive income iceberg. The income you see on screen, the deposit notifications, the revenue dashboards, the screenshots, that's the tip. That's what's visible. It's impressive looking, but what's hidden beneath the waterline is the full picture. The months or years of upfront work, the capital required, the ongoing maintenance, the taxes, the risks, and the failure rate. You see, the iceberg is almost entirely underwater, and the people selling you courses only ever show you the tip. Let's get specific. The median US household that earns any passive income at all brings in about $4,200 per year. That's about $350 per month. And only about 20% of households earn any passive income in the first place. A 2024 study found that 67% of people who pursue passive income never generate meaningful revenue. Not meaningful like enough to retire on, meaningful like enough to cover a car payment. And yet those passive income promises keep coming. Dropshipping course creators claiming $10,000 a month, affiliate marketing YouTubers showing monthly commissions the size of a salary, print-on-demand sellers reporting effortless income from designs they made in 45 minutes. The data on all of these tells a very different story than the highlight reels, and we're going to go through it section by section. The analogy I keep thinking about is casino marketing. Casinos advertise the jackpot winners. They don't advertise the statistical reality of the average outcome. The passive income industry works the same way. The house always wins because in this case, the house is the person selling you the course. So the practical takeaway here is, before even getting into specific strategies, anytime someone is selling you a passive income system, ask yourself what their actual business model is. If the answer is selling the course about the system, that is a major red flag. The most profitable passive income strategy in the passive income industry is selling passive income strategy. So before you buy another passive income course or program, Google the creator's name plus income disclosure, or FTC. You'll learn a lot very fast. 90% of dropshipping stores fail in the first year. They didn't tell you that part. This section is about passive income, specifically the gap between what's advertised and what actually happens to the people who try it. So let's go through the most aggressively marketed passive income strategies and look at what the numbers actually say. First up, drop shipping. You've seen the ads: zero startup cost, sell products online without inventory, make money while you sleep. That pitch is compelling. Now, the reality: between 80 and 90% of new dropshipping stores fail within the first year. Only 1.5% of stores ever exceed $50,000 in monthly revenue. That's gross revenue, not even profit. Successful stores typically earn between $1,000 and $5,000 monthly in sales. After advertising costs, platform fees, product costs, and returns, net margins run 15 to 20%. So that $10,000 a month store is netting $1,500 to $2,000. Realistic startup capital is $5,000 to $10,000. Not zero. Affiliate marketing. The average affiliate marketer earns around $8,000 a month, which sounds good until you understand the distribution. 41% earn less than $1,000 monthly. 23% earn literally zero. Beginners in their first year average somewhere between $0 and $636 per month. Affiliates with 3 or more years of experience earn nearly 10 times what those beginners make. That means the timeline to meaningful income is measured in years, not weeks. Print on demand. Upload a design, sell a t-shirt, passive income forever. The actual earnings data: the average listing on merch by Amazon or Redbubble earns approximately $1 per month per active design. A seller with 100 designs, which is a significant body of work, might earn $100 monthly. First year earnings for most new sellers land between $500 and $1,500 total. And the market is getting more crowded every month, with AI generated designs flooding every platform and shrinking margins even further. Next, MLMs. I'll keep this brief because we've covered MLMs before, but they belong in any honest conversation about passive income. The Federal Trade Commission reviewed 70 MLM income disclosure statements and found that most participants earn $1,000 or less per year before expenses. In at least 17 of those 70 companies, most participants made no money at all. Research submitted to the FTC calculated that 99.7% of MLM participants lose money when all expenses are factored in. Those numbers have been available for years, but they didn't make it into that recruiting pitch. Now, and this is important, none of this means that nobody succeeds at any of these things. People do succeed, but the question is what the realistic probability is and what the realistic investment of time and money is, and whether the people selling you the entry point are giving you an accurate picture of either of those. In almost every case, they are not. Here's a useful rule of thumb. If a strategy is being marketed heavily as passive income, and the marketing itself seems to be the primary revenue driver for the person marketing it, be very skeptical. The FTC has been cracking down hard on exactly this pattern. In March of 2025, they shut down an operation called Click Profit. They were charging people between $45,000 and $75,000 for AI-powered Amazon stores promising passive income. About 14% of those stores earned zero sales, and Amazon suspended 95% of them. The FTC secured $20.9 million in judgments. The FTC also took action against Learn Inc., a business coaching scheme, covering $2.4 million for harmed consumers. These are not one-off bad actors. They are the logical endpoint of an incentive structure that rewards selling the dream over delivering a result. Go ahead, search the FTC's website at ftc.gov for any online business opportunity you're considering buying into. They publish enforcement actions and have a free database of deceptive income claims. Want to know what truly passive income, the kind that requires zero ongoing work, actually pays? I'll do the math for you. Passive income is real, but the version that's genuinely passive, with money coming in with no ongoing effort, requires one thing that the influencers downplay, and that is capital. Here's the honest math on every major truly passive vehicle as of 2026. High-yield savings accounts are the simplest place to start. Top-tier HYSAs from online banks are currently paying around 4% APY. So what does that mean in practice? $10,000 earns about $408 per year, roughly $34 a month. $50,000 earns about $2,040 a year, about $170 per month. $100,000 earns about $4,080 a year, about $340 per month. This is the most genuinely passive income that exists. Open the account, deposit the money, do nothing. Now the catch, after inflation running at about 2.4%, your real return is around 1.6%, and rates will continue declining as the Fed cuts them. Now, dividend investing has more upside but requires patience or serious capital. S&P 500's dividend yield right now is about 1.17%, which is near a historic low. So $100,000 in a total market index fund generates about $1,170 a year in dividends, less than $100 a month. If you want more income now, dividend-focused ETFs offer higher yields. SCHD, Schwab's US Dividend Equity ETF, yields around 3.5%. VOIM, Vanguard's High Dividend Yield ETF, yields around 2.45%. To generate $500 a month in dividends from SCHD, you'd need approximately $171,000 invested. For $2,000 a month, you're looking at roughly $686,000. Those are real numbers. They can be scary, but they're actually achievable through patient investing that takes years, decades, not weeks. REITs, or real estate investment trusts, offer a middle ground. These are companies that own real estate and pay out at least 90% of taxable income as dividends. U.S. equity REITs average a yield of about 3.97% in late 2025. REIT ETFs like Vanguard's VNQ yield around 3.5 to 3.8%. The upside is higher yields than broad market funds, real estate exposure without actually owning property. But the catch, 78% of REIT dividends are taxed as ordinary income rather than at the lower qualified dividend rate. They're also more volatile than bonds. They fell 68% in 2008, best held in tax-advantaged accounts. So let me give you a comparison table in plain English, assuming $100,000 is invested. High yield savings account at 4%, $348 a month. Near zero risk, zero ongoing effort. CHD dividend ETF at 3.5%, $292 a month. Moderate market risk, minimal effort. REIT ETF at 3.5%, $292 a month. Higher volatility, still minimal effort. The S&P 500 total market at 1.2%, $98 a month in dividends, with the trade-off of being far better long-term total return. So here's the framing that I find most useful. The boring, truly passive vehicles do not generate exciting content. A high yield savings account earning $34 a month from $10,000 is not going to make a compelling YouTube thumbnail, but it is genuinely passive income that works, requires no skill, and can be set up today in about 20 minutes. So go to NerdWallet's high yield savings account comparison page and look up the current top APY rates. If your savings are in a bank paying less than 4% right now, you're leaving real money on the table. A blogger shared their real numbers: 300 posts, 2 years of work, $1,500 a month. Is that passive income? Kind of. Is it what's advertised? Not even close. This is the passive income episode, and we're talking about what these strategies actually earn, including the ones that require your time instead of your capital. Not everyone has $100,000 to park in a dividend ETF. Some people have more time than capital, and for them, the appeal of effort-based passive income streams is real. I know that sounds like an oxymoron, effort-based passive income, but let's look at the honest data on the three most popular ones. First up, online courses and digital products. The pitch is irresistible. Record a course once, sell it forever, passive income in perpetuity. The actual platform data, here it is. The average Udemy instructor earns $3,306 per year. 75% of instructors earn less than $1,000 annually. Only about 1% ever earn a full-time income. The top 1% of instructors capture over 50% of all the revenue. On Gumroad, the average creator earned about $70 total in 1 year, with the top 1% taking 60% of all revenue. Even on Kajabi, where creators tend to be more professional and intentional, average annual revenue is around $37,000, and that's people running it like an actual business with ongoing marketing. So the record it once and forget it version is a fantasy. Successful course creators spend 10 or more hours weekly on marketing, updates, and answering customer questions. Next up, blogging. A 2025 blogging income survey found that blogs under 1 year old average $2.42 per month. Blogs between 1 and 3 years old, $205 a month. 3 to 5 years, $1,045 per month. 10 or more years, $1,625 a month. The traffic reality is brutal. Blogs with fewer than 5,000 monthly page views earn about $47 a month. Blogs with 50,000 to 100,000 monthly views earn over $5,000 a month, but getting there typically requires 300 or more published posts. Around 80% of blogs fail within 18 months. Is a successful blog passive income? Sort of. Once it's built, it can generate income with less active effort, but the build phase is measured in years, not months. Let's talk rental property. This one is probably the most legitimate of the effort-based streams, but it comes with significant capital requirements and is nowhere near as passive as advertised. Gross rental yields typically run 5 to 8% in most US markets. After taxes, insurance, maintenance, vacancy, and property management costs, net yields compress down to 3 to 5%. The widely used 50% rule, meaning operating expenses eat roughly half of gross rental income, holds pretty broadly. Entry capital is substantial. $300,000 investment property requires $60,000 to $75,000 for a down payment, plus closing costs, plus reserves. With investment property mortgage rates currently around 6.5% to 7%, many markets show thin or even negative initial cash flow. Self-managing landlords typically invest 5 to 15 or more hours monthly per property. 3 a.m. emergency calls are not passive. Property management fees of 8 to 12% of rent reduce returns even further. 73% of landlords do report consistent profitability over time, but it's a business that requires active management, not a stream that runs itself. YouTube. Since we're here, it's worth addressing because a lot of passive income content specifically recommends building a YouTube channel as a path to passive income. Less than 1% of all YouTube channels earn any ad revenue. 97.5% of YouTubers don't earn enough to reach the US poverty line. YouTube RPM, or revenue per thousand views after YouTube's cut, runs roughly $4 to $8 for personal finance content, what I build. A video hitting 100,000 views might generate $400 to $800. That's meaningful, but getting there consistently takes years, and maintaining a channel requires significant ongoing effort. Tell me about it. Here's the framework I want you to take away. Effort-based passive income streams are really just businesses with delayed monetization. You're front-loading enormous amounts of work for a potential payoff that takes years to materialize. Most people don't make it that far. That's not a reason never to pursue them. It's a reason to go in with accurate expectations, treat it like a business, and not mistake the highlight reel for the average outcome. If you're considering any effort-based passive income stream, like courses, blogging, or YouTube, spend 30 minutes on that platform's official creator page looking for earnings data or income disclosure information. Udemy, Gumroad, and most major platforms do publish it. Search platform name, creator earnings data, and read what the median creator actually makes before you invest significant time or money. There's a passive income spectrum, and where you should start depends entirely on where you are in your life, not what someone on the internet is selling. We've been talking about passive income, and now I want to give you a framework that's actually actionable for real people at different life stages. Dr. Jim Dahl at the White Coat Investor published what I think is the clearest framework for thinking about this, the passive income spectrum. Here's the core insight. Every passive income stream sits somewhere on a spectrum between totally passive but low yield and high potential but requires active effort. As you push towards higher income, two things happen simultaneously. The risk goes up and the income becomes less passive. Let me walk you through the spectrum from left to right. On the far left, we have the most passive: money market funds, high yield savings accounts, CDs, and treasury bonds. These are genuine set it and forget it income. Current yields are maybe 4 to 5%. Capital required for meaningful income is significant, but there's zero ongoing work. These should be the foundation for anyone who has accumulated savings and wants some income from them. This is a good place to park your emergency fund. So Moving right, we get to dividend ETFs, REIT ETFs, and index funds. These are still very passive. You have to rebalance them once or twice a year, but you can otherwise ignore them. Yields are 1.5% to 4%, with long-term total returns being the real story. This is where most people's wealth building efforts should go, not as an income source today, but as the engine that builds the capital for future income, early retirement or regular retirement. Further right, we get to direct real estate, rental properties, real estate syndications. These have higher potential income of 3 to 8% net yield, but significantly, they're more active. Real estate is a business. Pretending otherwise is how people end up exhausted and cash poor. Now, on the far right, we have digital products, content platforms, affiliate sites, and online businesses. These have potentially the highest income ceiling of any passive stream, but it requires the most upfront labor, has the highest failure rate, and offers the least predictable outcomes. These are appropriate for people with a specific skill, a real audience, or a genuine competitive advantage. Here's how I'd map these to life stages, and this is the practical takeaway I want you to walk away with. If you're early career, more time than capital, one reasonable move is to pursue any effort-based income project that aligns with genuine skills you already have, while simultaneously starting to invest wherever you can in index funds. Not 10 projects, one. Treat it like a business, not a side hobby. If you are mid-career with rising income, the math starts to favor capital deployment. Pay yourself first, max your tax-advantaged accounts, and let compounding work. Use any extra income to eliminate high-interest debt, not to fund speculative passive income experiments. If you're late career with significant capital, shift allocation towards income-generating vehicles, dividend ETFs, REITs, potentially direct real estate and markets that work out. Now your portfolio can generate meaningful monthly cash flow. The critical mistake, and the one that passive income gurus exploit, is trying to skip rungs. The person promising you'll replace your income in 6 months with dropshipping or affiliate marketing is asking you to skip the foundation and jump straight to the top. That's not how compounding works. That's not how skill development works. It's not how real financial security is built. The boring version of passive income looks like this. Invest consistently, reinvest dividends, and wait. Let the compounding do its job. A 25-year-old putting $500 a month into a diversified index fund at 10% average annual return reaches approximately $1.3 million by age 55. Not from any clever system, from patience and consistency. Morgan Housel puts it well. His strategy is simply to own index funds for as long as possible, meaning to be average for an above average period of time. That is boring. It's also the strategy with the highest probability of actually working. Pull up a compound interest calculator. I like the one at investor.gov. Plug in your current monthly investment amount, run it out 20 or 30 years. That number is your real passive income machine. See what happens when you increase the monthly contribution by $50 or even $100. One more thing worth saying, the tax definition of passive income is narrower than the popular definition. The IRS defines passive income as trade or business income in which you don't materially participate, plus rental income. So dividends and interest are technically portfolio income under the tax code, which is a separate category. This has practical implications for how passive losses can be used and how different income streams are taxed. Make sure to talk to a tax professional if you're building meaningful passive income streams across multiple vehicles. Open a brokerage account, Fidelity, Vanguard, Schwab, pick one if you don't have one already. Set up a reoccurring automatic investment for any amount, even $25. That's rung number one. You don't need a strategy meeting or a course. You don't need to buy anything. You just need to start. Here's your 30-minute homework assignment for this episode. Open up your bank app and your brokerage account. If you don't have a brokerage account, that's step one, to open it. Find out exactly what your money is currently earning. Check your savings account's APY. If it's below 4%, you are leaving real money on the table right now, today. The top high-yield savings accounts from online banks are paying around 4% on your first day. That's not complex to fix. Just move the money. Second, run the compound interest calculator at investor.gov. Put in your current monthly savings amount, your current invested balance, and run it out 20 years. That number, the long-term compounding income, is your real passive income machine. You don't need a course. You don't need a Shopify store. You just need that number. Third, write down one passive income idea that you've been thinking about or are tempted by. Then Google that platform's income disclosure statement. Udemy has one. Etsy sellers have real earnings data online. Most platforms publish something. So see what the median and average creator actually earns. Compare that to the income claim in whatever video or ad that tempted you. That gap between the claim and the data is exactly how much money the person is making the claim is making off of you. 30 minutes, you'll walk away with a clearer head and probably a higher savings rate. We covered a lot of ground today, so let me bring it back to the promise I made at the top of the episode. I told you there's an enormous gap between what's being sold and what the data shows. Here's the full picture. Truly passive income is real, but it pays modestly, and it requires either significant capital or significant time. $100,000 in a dividend ETF earns you about $300 per month. A high yield savings account earns you $340. A REIT ETF, about the same. These are legitimate, genuinely passive income streams. They are not going to replace your income next year. Over a decade or two, they can become a meaningful part of your financial picture. The effort-based streams, courses, blogs, YouTube, dropshipping, affiliate marketing, they have a tiny minority of real winners and a large majority of people who tried, worked hard, and made close to nothing. The platforms publish the data. The course sellers do not lead with it. The thing that actually works for regular people is boring. Invest consistently, stay in low-cost diversified funds, reinvest your dividends, and wait. The compounding math on patient, consistent investing is genuinely remarkable. You don't need to beat it, you need to let it work. The passive income industry will keep trying to sell you shortcuts. The iceberg will stay mostly underwater. But now you know what's under there, and you can make decisions based on the full picture. If this episode was useful to you, do me a favor, share it with someone who has been tempted by a passive income course lately. Send it to a friend who has been watching dropshipping content or looking at MLMs. This is exactly the kind of episode that's worth passing along. You can find Your Money on Easy Mode on Spotify, Apple Podcasts, and YouTube. New full episodes drop every other Sunday. If you want to support the channel, the best thing you can do is subscribe, leave a review, and share the show with a person who would get something out of it. I'm Damien. Thanks for listening. Now go check your savings account's APY. You've been warned.
Thanks for listening to Your Money on Easy Mode. If you enjoyed this episode, then please subscribe and share it with a friend.